Many people delay investing because they believe they need thousands of dollars before it's worth getting started. But one of the biggest advantages in investing isn't having a huge amount of money, it's starting early and staying consistent. Even a portfolio built with just $500 can become the foundation of significant long-term wealth when combined with regular contributions and the power of compounding. That's why ETFs have become a favorite tool among many successful investors. They offer diversification, low costs, and exposure to entire markets without requiring constant research or stock picking. Today, we will talk about $500 ETF portfolio that could build wealth. So before we get started, make sure to hit that like button, also subscribe to my channel. 10. Why $500 is more powerful than most people think. Many people believe they need thousands of dollars before they can start investing. But the truth is that wealth building often begins with a small first step. A $500 ETF portfolio may not make you rich overnight, but it can become the foundation of a long-term financial strategy. The biggest advantage of starting early is not the amount of money you invest, it is the time you give your investments to grow. Many successful investors did not wait until they had a large bank account. They started with what they had, invested consistently, and allowed compounding to work over many years. The first $500 is important because it creates the habit of being an investor, rather than someone who only saves money. 9. Build around broad market ETFs. If I were creating a $500 ETF portfolio, I would focus first on broad market exposure rather than trying to predict the next company that will dominate the future. Broad market ETFs allow you to own small portions of hundreds or even thousands of companies through a single investment. This reduces the risk of depending on one business or industry. Many long-term investors use diversified funds because they provide exposure to different sectors of the economy, including technology, healthcare, consumer goods, financial services, and industrial companies. The goal is not to find the perfect stock, it is to participate in the long-term growth of businesses across the market. 8. The core of the portfolio. $300 in a broad market ETF. The largest part of the $500 portfolio would be dedicated to a broad market ETF. Putting around $300 into a diversified fund creates a strong foundation because it spreads your investment across many companies instead of relying on a single winner. This portion of the portfolio is designed for stability and long-term growth. It represents the idea that the world's largest and most successful businesses have the potential to continue innovating, creating products, and generating profits over time. By making this the largest allocation, the portfolio focuses on consistency rather than speculation. 7. Add growth through technology and innovation ETFs. The next portion of the portfolio could be focused on sectors with higher growth potential, such as technology and innovation. For example, allocating around $100 to technology-focused ETFs provides exposure to companies involved in areas like artificial intelligence, cloud computing, semiconductors, and digital infrastructure. These industries have transformed the global economy and may continue to influence the future. However, growth sectors can experience larger price swings, which is why they should represent only a portion of a balanced portfolio rather than the entire strategy. 6. Include international exposure for global growth. Many investors make the mistake of keeping all their money in one country or market. A well-rounded portfolio can include international ETFs that provide exposure to companies outside the domestic market. Investing around $50 in international funds allows participation in global economic growth and reduces dependence on a single region. Different countries and industries may perform differently over time, so global diversification can add another layer of balance to the portfolio. 5. Keep some exposure to defensive sectors. Not every part of a portfolio needs to focus on aggressive growth. Defensive sectors such as healthcare, utilities, and consumer necessities can provide balance, because these industries often continue operating regardless of economic conditions. Allocating the remaining $50 to defensive or lower volatility ETFs can help reduce overall portfolio fluctuations. This does not eliminate risk, but it creates a more balanced approach between growth and stability. 4. The real secret is adding more money consistently. The biggest mistake new investors make is focusing only on their initial $500. While choosing a good portfolio matters, the real wealth-building power comes from adding money regularly. A person who invests $500 once and never contributes again may see some growth over time. But someone who continues adding $100, $200 or more every month can potentially build a much larger portfolio. Consistent investing allows you to buy assets during both good and bad market conditions and takes advantage of long-term compounding. 3. Ignore short-term market noise. The stock market moves every day. Headlines will constantly talk about crashes, recessions, inflation, political events, and new technologies. Many beginner investors become emotional and make decisions based on fear or excitement. They buy when prices are high because everyone is optimistic and sell during downturns because they are afraid of losing money. Long-term investors understand that market volatility is normal. They focus on their strategy, continue investing, and avoid making decisions based on short-term news. 2. Reinvest and let time do the heavy work. One of the most powerful strategies for building wealth is allowing your investments to compound. Any dividends or returns generated by your portfolio can be reinvested to purchase additional shares, which may create more returns in the future. At first, growth can seem slow, and many people become impatient. However, compounding becomes more powerful over long periods. The investors who often see the greatest results are not those who make perfect decisions every month, but those who remain consistent for many years. 1. Your $500 portfolio is the beginning, not the finish line. The biggest lesson about building a $500 ETF portfolio is that the amount you start with does not determine your final result. The true wealth-building formula is simple. Start early, invest consistently, stay diversified, control your emotions, and allow time to work in your favor. A small portfolio built with discipline can eventually grow into a much larger financial asset. The people who create significant wealth are rarely those who wait for the perfect moment or the perfect amount of money. They are the people who start with what they have and continue building year after year. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.